Hey everyone, let's jump straight into this explainer. Today, we're doing a complete teardown of the Q1 2026 earnings, financial health, and strategic horizon of Provident Financial Services. We're going to unpack exactly how this historic New Jersey-based bank is navigating the current economic landscape, leveraging its recent acquisitions, and positioning its massive balance sheet for the future. So whether you're trying to figure out their commercial real estate exposure or you just want to track where the institutional money is flowing, this explainer is going to decode all of it for you.
To keep things moving, here's our roadmap. We'll start with the big picture, move into earnings and financial health, take a look inside the loan portfolio, gauge market sentiment, and finish up with their strategy and future outlook.
All right, Section 1, the big picture. Provident Bank's core franchise engine. Let's get into it.
So Provident commands a seriously impressive franchise scale. We're talking an expansive network of 141 branches, driving localized deposits across New Jersey, Eastern Pennsylvania, and key counties in New York. Fun fact, they were actually founded way back in 1839. That is decades before the Civil War. It literally makes them the longest tenured bank headquartered in New Jersey. Today, they are sitting on over $25 billion in total assets. And crucially, they fully integrated their Lakeland merger, meaning those operational cost savings are already baked right into the footprint.
But it's not just traditional banking. This is a massive number, $4.2 billion. That is the assets under management in their rapidly growing wealth management arm, spread across just over 1,000 family relationships. Through their Beacon Trust division, Provident is aggressively pivoting away from relying solely on interest-bearing loans. They're leaning hard into advisory, trust, and estate services. And you know why? Because it creates this beautiful, stable cushion of fee-based income that perfectly complements the physical branch network.
Moving right along to Section 2, earnings and financial health. This is the fuel powering the engine. They delivered a very solid diluted earnings per share of 61 cents this quarter. What's really driving this is expanding net interest margins. Put simply, they're making more on the loans they issue than they are paying out to depositors, all while keeping a tight lid on operating expenses. CEO Donovan P. Turnus specifically called out this quarter-over-quarter expansion. Zooming in, they hit a 1.29% return on average assets and pulled in $225 million in revenue, which was driven by both net interest income growth and record non-interest income. Not too shabby at all.
Now, these valuation ratios are practically screaming financial discipline. When you pair an 11.10% return on equity with a trailing price-to-earnings ratio of just 9.43, you are looking at a bank generating serious profits relative to its current market price. On top of that, their pre-provision net revenue return on average assets expanded to 1.75%. That's a vital metric, you guys, because it shows you the raw, underlying earning power of the bank before you even factor in credit loss provisions.
And we can easily connect the dots between that performance and their next move. They generated a super healthy $424 million in free cash flow over the last 12 months. What did they do with it? Well, they authorized a stock repurchase program for up to 5% of their outstanding shares. In fact, they've already snapped up about 588,000 shares recently at an average cost of $21.04. So what does that tell us? It tells us management clearly thinks their stock is undervalued, and they have the capital strength to step in and directly reward their shareholders.
Let's transition over to Section 3, inside the loan portfolio, where the capital is deployed.
So they have a $3.51 billion commercial real estate portfolio. Now, I know commercial real estate can sound a bit scary right now, but look at the actual breakdown. It is heavily but safely diversified. Multifamily properties are the biggest slice at over 33%, followed by retail at almost 24%, and industrial right around 19%. The absolute key takeaway here? Office space makes up less than 7% of this portfolio, so they are largely insulated from the most brutal headwinds hitting the commercial real estate sector today.
And despite all the general market anxiety around regional banks, Provident's credit quality remains exceptional. They have a massive, record-breaking loan pipeline sitting at $3.11 billion, backed by incredibly strict underwriting standards. They definitely aren't just sitting on their hands. Total commercial loans actually grew at an annualized rate of 3.9% this quarter, letting them pull in highly attractive yields averaging 6.24% right onto their balance sheet.
All right, Section 4, market sentiment. Let's see what the hedge funds and insiders are up to.
Looking impartially at the latest institutional filings, it's basically a tug-of-war out there. 119 institutions added to their positions, while 130 scaled back. But the real story is who is doing the buying and selling. We saw massive inflows from Prudential Financial, boosting their stake by an eye-watering 187%, right alongside big buys from American Century. On the flip side, heavyweights like UBS Asset Management and the Quant Fund 2 Sigma drastically slashed their holdings. It is literally a textbook battle of institutional perspectives on the regional banking sector.
Now, what about the people inside the building? Recent Q1 disclosures do show some moderate insider selling. Executives like George Lista, Robert McCracken, and Executive Chairman Christopher Martin sold off smaller batches of shares, adding up to roughly $300,000 combined. Now, is this a glaring red flag? Not necessarily. Executives sell for all sorts of personal financial reasons. But it's absolutely a data point that retail investors weigh when trying to gauge internal sentiment and time their own trades.
Which brings us to our final part, Section 5, Strategy and Future Outlook. The horizon for Provident.
I want you to focus on this number, $5 billion. That's their available liquidity. It's a staggering war chest. In a financial climate where liquidity is absolutely king, having over $5 billion in borrowing capacity gives them incredible balance sheet flexibility. It is the ultimate safety net for unexpected storms, sure, but more importantly, it is pure dry powder ready to fund aggressive loan growth or even fuel future M&A, all without stressing their core operations.
Based on recent strategic analysis from Matrix BCG, Provident's forward strategy is incredibly calculated. It's all about balancing stability with optimization. They're aiming to keep their Common Equity Tier 1 ratio, basically the ultimate measure of a bank's safety, right near 10.5%, while targeting a solid dividend payout of 40 to 50% of core earnings. On the operation side, they are actively rotating away from lower-margin residential mortgages and doubling down on those high-yielding commercial assets we talked about earlier. Plus, they're taking the cash saved from the Lakeland merger and pouring it straight into digital branch upgrades.
So let's wrap this all up. Looking at all these moving parts, we have to ask the big question. With their net interest margins expanding, super disciplined credit underwriting, and an absolute fortress of $5 billion in liquidity, is Provident just playing defense and protecting its 141-branch footprint in the Northeast? Or is this highly calculated capital positioning actually gearing them up for their next massive wave of regional expansion? It's a fascinating dynamic to watch play out in 2026. Thanks for joining me for this explainer. I really hope this deep dive gave you the clarity you need to track Provident's story going forward.